presentation contains current opinions of Moe Sansari, Chief Investment Officer of Compact Asset Management, a registered investment advisor, and are subject to change. Nothing in this presentation should be considered investment advice. We make no assurance that Moe's opinions or illustrations will accurately predict future prices or financial markets. In no event is past performance a guarantee of future performance. A detailed disclosure can be found at the end of the presentation. And now here's Mo.
Hello everyone, and welcome to the Compact Market Wrap YouTube update for October the 7th, 2025. I'm Mo Ansari, President of Compact Asset Management, and thank you for joining me today. Let's start first of all by reminding all of you, don't forget to subscribe to this channel. Click on the subscribe button so whenever I post an update, you'll be notified and you can watch it at your convenience. And for clients, special announcement, tonight is going to be the quarterly webinar for all of you. It's for clients that we update you what we did in the last quarter, what we're expecting in the next quarter. It's a nice detailed overview of the economy, overview of the markets. So don't forget to tune in for that this evening. It is absolutely free for all of the clients. You already have the link to it, so make sure you tune in at 6 p.m. today. Looking at the markets last week, great week in the markets, up 1.1% for the S&P, up nearly 15.33% for the year. Looking at the Dow, also up 1.11%, up 11.33. NASDAQ up 1.33% for the week, up 18.5% for the year. So it's been a wonderful, wonderful year so far, even though we had volatility in April. But since then, we're back up and we're up nicely. Healthcare is starting to come back up with all the announcements of the government giving discounts on drugs. Utilities, technology, second best sector. Energy was down a little bit after the great run it had over the last 3 weeks. Oil, $60 a barrel. It is sitting absolutely nowhere compared to where it was at the beginning of the year. So we're down about $12 a barrel, and OPEC is expected to increase production because they're worried about market share now rather than price. So it'll be interesting to see where prices go, but I don't see any dramatic move in oil prices. Interest rates also lower. We went from 4.2% on the 10-year to 4.13. So they came down quite a bit last week, and that helped the market. The expectation is, as I will talk about in the webinar this evening, that we are expecting another rate cut at the end of this month and a third rate cut for the year in December. So they're expected to be 2 more interest rate cuts. And I think that is the main driver of the stock market at this point, even though we have the government shutdown. And I'll talk about that in a lot more detail in the webinar. But historically, we look at it going back to the 1980s when we had the first shutdown in the government, and it has really had no impact on the market. The longest one was 34 days, I believe, during the last Trump administration. So we'll see. This could last. The big date coming up for the deficit for the budget talks is October 15th. That's when the government pays the military, and if the military misses a paycheck, it's going to be 1.3 million people that are not going to get paid. Yes, they are going to get paid later on when the government reopens and they get the checks for the time that they worked, but cash flow is something. If you don't get a paycheck on time, you still have to pay rent, you still have to buy groceries. When the money is not coming in, it could create some issues. So I think October 15th will be something to watch as far as the talks are concerned and the budget government shutdown is concerned. We are starting to see some credit stress, private credit. You can see that rates, including distressed exchange, non-accruals, you're seeing they're starting to go up a little bit. And that shows that people are starting to get a little bit stressed as far as spending goes, even though retail sales are great so far, but we'll have to keep an eye on that as unemployment starts to go up a little bit. That will definitely, we have to watch what is happening to credit defaults and so on. Consumer confidence fell in April to 94.2. Jobs openings, people are concerned about the unemployment numbers and jobs. Well, job openings went up. That means there are more jobs out there. By about 7,000 more jobs were available when the last report came out. But again, that is a lagging indicator rather than a leading indicator. Looking at what we get, international trade balance, consumer credit. A lot of the government reports are not coming out, just like the unemployment report. We did not get it last Friday because of the government shutdown. So we'll get a lot of data once the government reopens. But in the meantime, there's very little government that is available, the data out there. We continue to march higher. This is the third wave. We continue to move up. We're right up here. Today we were down a little bit. 20-day moving average 66.45. We are somewhere around 67 and change today. So we'll have to see 67.14. Next support is 65.10. So if you come back down from 67 to 65, that's about a 200-point drop in the S&P if we get it. But that'll be wave 4 when we get that. And then we get from wave 4 to wave 5, which should take us to new highs. So if you see some short-term weakness, if we do, when it does come, I still see that as a buying opportunity. On the weeklies, we're seeing the 5th wave, but this can last for a long time, the wave 5, for months and months and months. So we could see some pullback a little bit here, but dailies have not topped out yet. So any pullbacks I still view as a good opportunity. Plus, whenever we see the market up in first 3 quarters of the year, usually that is a good sign for the market, and the markets have ended up. I think the only time they did not was 2012, when we have a double-digit gain in the market going into the last quarter. Besides that, every year, whenever the market has had double-digit gains like we have now, we usually end up the year higher. Same thing with the NASDAQ chart. Wave 3 is what we're looking at here. Wave 4 pullback. Somewhere it's going to happen. You come and kiss the 20-day moving average a couple of times. You kiss the 50-day right here, but that has come up. But that was at the beginning of last month when we were about 20,800. We're 22,800 now. So the market has gone up from. So if we do get a pullback to 21.8, which will be about 1,000 points, I still see that to the 50 days, still a view buying. Long term, weekly charts are still positive, and this has changed. It's gone from a wave 5 to a wave 3 on the NASDAQ. So if we do get a pullback here in the NASDAQ, a wave 4, we still have wave 5 to the upside left. So still looking good if we do get pullbacks on NASDAQ. Again, buying opportunities. 10-year yield basically going nowhere. Came down quite a bit. Hit this 4% area when the Fed cut rates, bounced back up to about 4.2, and now we're at about 4.12. So we're just going back and forth in this broad area of about 4% to about 4.6%, just back and forth, up and down. As long as rates stay around this area, I think the market can handle it pretty well. Gold is breaking out today, hit 4,000 on the S&P, on gold itself. The GLD also hit a new high, but it is extended. If we see government shutdown is helping the gold market right now, but if not, once we get a resolution, it'll come back. One thing we're starting to see some stress in the high yield market. You can see that it's starting to pull back. 80.73 is the 50-day. We closed at 80.77. If we get below the 50-day moving average, that'll get concerning. Then we're looking at somewhere around 80.5 or so. If we break below these lows, that could be a problem of 80. So we'll watch it carefully, see how this performs. This usually is a good leading indicator for where the market is headed or how the economy is doing. As long as the high yield bonds are doing okay, that means there's less stress. When they're not doing as okay, they're starting to go down. That shows the stress is increasing. So there could be time for a little bit of a pullback in the market. If we do get it, I would still view that as a buying opportunity. Those are my thoughts. Those are my what I'm looking at right now. Not a lot going on in the markets, relatively quiet, but we're starting to roll over. Again, if we do get a pullback, it'll refresh the market. That's the way we look. Don't forget to click on the subscribe button or go to compact.com, click on Insights. You'll get this YouTube update. You can also get the podcast that we do. Again, if you need help with your portfolio, want us to take a look at your portfolio, send me an email at invest@compact.com or give us a call at 800-388-9700. Those are my thoughts. Those are my observations. I will be back with you next week. Until then, good trading.
This presentation contains the current views and opinions of Moise Ansari, Chief Investment Officer of Compac Asset Management, a registered investment advisor. The views expressed are current only as of the date of this presentation and are subject to change. Nothing in this presentation should be considered investment advice, and nothing is personalized to any investor's individual circumstances. Compac Asset Management offers investment advice only after entering into an investment advisory agreement and gathering client-specific information about goals, objectives, financial status, and risk tolerance. This presentation uses terminology associated with technical analysis and provides charts to illustrate some of the concepts discussed. Technical analysis is a security analysis method with the goal of forecasting the direction of prices of securities or market indices through the study of past market data, primarily price and volume. We make no assurance that past performance or the use of technical analysis will accurately predict future prices. Further, a risk of technical analysis is that overfocus on historical patterns could lead to ignoring or downplaying security-specific concerns, overall market or sector concerns, or other factors because we assume inaccurately that historical patterns will repeat themselves. In no event is past performance a guarantee of future performance.